Want to take a look at a SPY put that we got into. Hit about 20-25% profit, did not last that long. And then we actually flipped in the opposite direction and went long the QQQ. And we hit in total about 125-130% profit. So I'm going to walk you through both of those trades, show you the setups. And before we get started, I want you to remember and try to focus on two key takeaways. One is overall trade management, and two is the breakout fake out trade. So with overall trade management, what I mean is watch the ability of how I was able to keep the bias away, right? Even though that, price started to sell and we were bearish and it looked good, once it started to pull up, I didn't, just switch my analysis to hope. I didn't stay in that trade because I wish it went back in the green or I wish it was a winner. I got out of the trade because what was happening on the charts, right? I didn't let my profit and loss make my decisions. I made my analysis determine my decisions, right? So focusing on what the analysis is saying is the key to that first part. And then two is the breakout fake out trade, or the fake out breakout trade, whichever way you want to put that. And what that basically describes is when price is stuck in a range or choppy, sideways, whatever you want to call it, right? When price is in a range, if there is a breakout to one side that results in a fake out, which would be, say, the break below, and then we go back into the range, that would be a fake out, right? You break below the range and come back in. Sometimes this fake out sets up the fake out breakout trade, which means that there will be an even larger breakout to the opposite direction. And that actually happened today with QQQ and SPY. So those are the two main focuses, right? Trying to understand both of those. Now let's get started with SPY. So on the 5-minute, the moral of, or the overall setup of this trade was watching that 514 key resistance. We can see that in the morning after CPI came out, it was still being pretty consistent. We can see that 512 was holding as support throughout the pre-market. And not only is that the reason that I was watching 512, but it was very close to the high of day yesterday. So if I was to go long, if I was to watch this channel, I wanted to see price hold over that high of day yesterday, right, which it was doing in the pre-market. To the downside, I was looking for 508.5, which was the low of day yesterday. And to the upside, I was looking for new all-time highs. So we're stuck heading into open, right? We're stuck in this 2-point channel between 512 and 514. And my pre-market analysis, I thought that the best trade to the upside would be a break and hold over 514, and the best trade to the downside would be a break and hold below 512, right? Either direction this thing wants to go, I'm comfortable trading that. So we head to open. I'm going to zoom into the 1 minute, and we're going to see that price started to slip, right? It had a little bit of a push to the upside. It got close to the top of our range. And then what happened, as it has continued to happen at that top of the range, is selling pressure, right? So we come back down to 512. We're looking for support. And if we don't get it, maybe we can go short. So let's see. We're starting to hold, and no, we do not. All right. So you have the failure of support at 512. We're starting to get wicks off of that level too, right? Because we're seeing something different, right? Price isn't falling to the support and bouncing off of it. Price is falling below the support and rejecting it. This would be price action acting as support. This is price action acting as resistance. So I start to see resistance at this previous support level, and that starts to get me interested in a trade. So I'm setting up my risk to reward, seeing if it's worth it. Of course, the risk to the upside looks at about 50 cents, to the downside, targeting low of day yesterday. It's a beautiful setup, right? Over a 1 to 6 risk to reward. So I like the risk to reward. I'm getting my confirmation in here. I'd like to see one more test of 512 in resistance, and maybe a test of that 9 EMA. Not that you have to use moving averages, but that's part of my strategy. I like to use moving averages because they're a trend indicator. And if I'm breaking out of a range, I want to see the trend of that breakout. So I hit play. I'm being patient. No entry yet. Here's another pullback into 512. Let's see some resistance. There it is, and we get that rejection. So at this point, as this 943 candle closes, right when it happens to be 944, I get into the trade. We enter, and pretty quick profits. A nice 3-point push, or a three candle push as we call it, and then we hit about 20-25% profit. Now at the same time this is happening, although the S&P has a lot of downside, I was also keeping an eye on the NASDAQ and the QQQ. And what I was seeing is that tech was getting close to a support/demand zone. So I realized that buyers were starting to show up on tech names, and tech is a very crucial part to the S&P 500. So I was started to think, even though that I was winning, even though I was in a position that benefited from more downside, this is the importance of having no bias, right? Just looking at the chart and being objective, not subjective. So I'm looking at the price action falling. I think the trade's great. It's in profit. It's got a good risk to reward, et cetera, et cetera. But technology is looking really strong off of a bounce from a key demand zone. If technology continues to bounce off of that level, that could be enough fuel to push this back into the range. And I don't want to be in puts if we get above that area. I definitely don't want to be puts if we're in the range. So at any moment, I'm ready to get out if we start doing that. But if this holds and the downtrend develops, I've got no reason to get out of the trade. So what we've done here is set up this unbiased if/then, right? We're prepared for this to go well. We know how to handle it. And we're also prepared for this to go bad. We know how to handle it. And being prepared and having a plan for whatever the trade wants to do, it makes it very, very easy to either help your winners develop longer or keep your losers small. And in the best case scenario, not only keep your losers small, but get on the right side of the overall trade. So we start to pull back up, or we float around a little bit down here, and then now we start to pick back up. And you can see that we start pushing into the red. You know, the fact that we trim down here at about 20-25% profit, it gives me some wiggle room to let this trade develop a little bit, right? We're in the red a little bit here, but since we trimmed overall in the position, we're either break even or in some type of small gain. So I start to see tech pull up, and directly at, I'm just looking back at the order history, directly at 952 we get out of the trade. So once this 951 candle closes, I am taking my exit. So I take that exit right in here. I didn't wait for my stop loss. I didn't wait for the break over 512. This started to come back into the red. We started to gain a higher low. Technology was bouncing. That was enough for me, right? If we did hold 512 and started to reject again, I would be okay with getting back into puts. But this was not developing to the degree that I not expected it to, but to the degree that would have kept me in the trade. So we get out of this. So what we started looking at was the Qs. And the reason that I looked over at the Qs is because SPY pulled back into its channel. Right, if I look back into the Qs at about 10:06, right, let's rewind to 10:06 right here. We'll see that SPY was still in this trade. Now, we talked about the fake out breakout trade, right, where you have a fake out to one direction and then the breakout to the opposite direction of the channel is usually the larger and real breakout. Now, you don't enter just because this failed and we got back into this range, right? We don't just enter here. Why? Because we're back into the channel. And our game plan was to not trade in the channel, right? We were looking for a breakout above or below. So if we pull back into the channel and we just get into calls, that's going against our game plan. In order to successfully and more confidently trade the fake out breakout trade, we need to buy the breakout in the other direction. So in order to go long on SPY, I was waiting for a move above that 514. I saw the fake out. We're back in the channel. Now I need to see the breakout to catch that big potential move. Now I was ready to get into a trade, and I wasn't forcing myself into another trade, but I started looking around, right? I realized that we had this big bounce. We're back to consolidating on the broader market. Maybe we are going to have that breakout, but I also know that this move was coming from tech, right? This move was coming from the QQQ, for example. So I started to look a little bit further into this. Now this is fast forwarded from our exit on SPY. On SPY, we got out at about 952, which is right about here. Prices continued to pull to the upside, and we started getting towards the high of day on QQQ. So if we were able to break and push into those high of days, if I was able to see some type of setup that would give me confirmation, that would show me an edge, then I would be happy to get into a trade and then aim for 442 or above, right? Because I know that there's space. High of day is 440, about 440.4. That's anywhere from that's anywhere from 1.5 to 2 points of upside. And the way that I trade, that could be a really good move for options. So I'm waiting here. I'm trying to get, some type of hit on price action. I see that we're getting some selling pressure at the high of day. That makes sense. Maybe we'll start consolidating here. You can see that we just bounced off of these lows. So we're actually, these recent highs in here, it looks like we're selling down to and buying off of those. So I find that pretty interesting. Let's see if that is significant. We sold down to them again. Do we buy off of them? Yeah, it looks like they held, and look, we got another push into the high. So what is price doing, right? Price is ranging now. It had that beautiful uptrend towards the high of day, but once it got to the high of day, it slowed down. It started to consolidate. Now, this is going to make people eager, antsy, right? Oh, why isn't it going anywhere? I need a trade. I need a trade. This is a blessing because this is the pause before a potential move. Now, this isn't, oh, when you see this, it's a 100% chance we're just going to break out, so just buy it no matter what. No. The idea is that this is a calm before the storm, right? This is consolidation. This is a pause before the expected continuation of that move. So it could break to the downside, and in that case, we just won't trade it, right? If someone wants to reverse trade it, they can, but my game plan was try to trade this continuation. If it fails, I won't trade it. If we have a breakout, I'll take a stab at it. So I'm waiting for that, right? I'm starting to see this range happen. I'm starting to see volume decrease, which I'm not a big fan of. But what that is showing me is that a potential trade entry might be on the horizon. So I hit play again. We see another pullback to these lows. And we bounce off of it once again, right? We're trading below it a little bit, but look at where all these closes are happening. We're starting to stay tight within this consolidation. What I'm also starting to see is we have a high here, a lower high, potentially a lower high, right? I'm making things a little bit more complex. I'm adding a little bit more, some people may call it noise, but I'm just trying to get a better feel on what price is doing here. I see that we're getting consolidation. I see that price is tightening, even getting lower highs. I see that volume is dropping off. And what does that tell me, right? All these different observations show me that price is coiling like a spring. And although we know it's not a 100% chance it's going to break out to the upside, we're here for the opportunity. If it does, we're ready to trade it. So I'm ready to get into calls. My target would be 442 or above. My stop loss would be this channel, right? It could be the top of the channel, the bottom of the channel. It could maybe be a midpoint if it creates, a smaller time frame high or low. And we hit play. And we hold those lows once more, and we start to get a break to the upside. So I took my entry on that break because we had a push above these highs in here. The candle closed up there. We had a huge push in volume, as you can see, to the downside. And the breakout and the volume was that combined confirmation. So I get into a trade right here. My stop loss being placed at these recent lows. My target is being placed at that 442. So I know that I have an edge. I'm trading with the direction of the market, and I have a good risk to reward over a 1 to 3. All of those things check off. I'm in the trade, and now it is my job to manage this as best as I possibly can, right? If this breakout is another fake out and we, just unfortunately happen to pull back into this level, I can see what happens, right? I have a plan. I have a stop down here. I have a support down here. And if that holds, I stay in the trade. But if that starts to break, right, I know that support is no longer holding. We're rejecting the high of day. It's going below my stop loss. If we do that, then I don't want to be in the trade, right? So we have a plan for the downside. Now, if this starts to break out, my plan to the upside is watch the higher lows be created, right? If we extend to the upside and then have a red candle, don't panic and get out of your trade and take a very small win, right? We want to try to stay in the trade and let it develop into that target. So we have a plan for the downside. We have a plan for the upside. I'm in that trade. I hit play, and very quickly, we get a nice pop to the upside right here. So at this point, it is about 1025, 1026, and we're already at about 25, 30% profit. So I'm pulling a little bit out of this trade. I'm reducing my risk, and I'm waiting for a pullback. We start to see a red candle, and it was high volume, right? It was a high volume red candle. So I imagine some people got faked out of that. You let the candle close, you see a green candle, very little reason with increasing volume, increasing buying pressure to get out of the trade. Now, right after that, there's some more selling pressure. And you can see that after the extension, we start to pull back into the previous high of day. Now, this red candle, another example of a point or a place where people see that and they go, well, it's a red candle, or there's selling, or, my position went from, 20% to 10% profit, so I'm going to get out. And that is the worst misconception about trading, is people say, oh, you can't go broke taking profits. That is exactly how a lot of traders do go broke, right? Because they get into a good trade where they have a good risk to reward, they have a good edge, confidence, comfort, all that good stuff is there. Their trade moves a little bit and they get out of it. They take a small win. Even if you're winning the majority of your trades, if you're taking small wins and on the back end you're having bigger losers, well, you will go broke taking profits, right? The way to fight against that is try to stay in winners longer and try to let those develop in your favor. Not just stay in them for as long as you can, right? If you hit your target in a minute, I understand taking profits, but I think you guys get the point that I'm trying to make here. So we see that red candle come into the picture. As we mentioned, definitely people getting out, panicking, the market's going to take away all my gains. Sometimes the best thing to do is just wait. We wait 1 minute and then we push new highs of day, right? So that 1 minute is the difference between you panicking and then you being back in the position where the trade is developing in your favor. All that is a pullback. So you hit play, 1, 2, 3, right? 3 minutes. So on the other side of that red candle is the door, right? And that door unlocks your profitability because many traders did this setup, got the risk reward, took that breakout and just got 20, 25% profit. And then think, right? That's not their average because it pulled down a little bit, maybe back to 10, 15%, and they took the rest there. And if you make a habit of doing that, your winners are going to be very small and it'll be more difficult for you to be profitable. So just waiting and letting the trade develop is sometimes the best thing to do. And as you see here, waiting 1, 2, 3, 4 minutes was the difference between 25% profit and up here, 45% profit, right? Almost doubling your profitability just by letting the trade develop. That is a huge way to change how profitable you are as a trader. So we're still in this trade, hits our target, and at that point, we're already at about 70% profit. This is just a classic and very clean breakout trade to the upside where we get in, let the position develop, trim and reduce our risk into the target, and call it a day. Now, that is where most traders would call it a day, and not to say that a trader or you would be wrong if you did get out of your full position here, right? You did hit your target. And we already talked about how, not getting faked out on the pullback, not getting out prematurely, letting your trade develop into your target. That's a good trade, right? Your main goal is to hold the trade as it develops, not exit prematurely and let it get there. But if the trade is still valid, such as, right, something as simple as an uptrend is still valid, we have to realize that this isn't a magical wall, right? And price can move through that. So if we have an uptrend that is still intact, that could be our decision on getting out of the rest of the position, right? Or even if we start to see the uptrend break and it starts to range sideways. Or better yet, right, maybe just watching for a new lower high to come in. But there is always that potential chance that it can keep going, right? That we can break out from this level. Like I said, it's not a magical wall. It's just levels where there should be some type of interaction. So maybe we see what the interaction does. And that is sometimes how we get these large winning trades. Like I said, this being at 70, 80% profit, that's great. But let me quickly show you how we could manage ourselves to seeing that potential for more profit. So one of the first things I like to do, right, especially when the market is not ranging sideways, but when the market is in an uptrend or downtrend, right, when we're trending, is look at the high of day or low of day. Sometimes there's going to be other trends existing and you'll already have something on your chart, but looking at the low of day or the high of day, and then look at current price and kind of follow a line in your head. Like this is the lowest we've been, that's where price is. You kind of get an idea on the direction. This is the highest we've been before the move up, right? So there's no downtrend that's active on the day currently. So I like to find the intraday trend. So here are the lows, right? We sat here for about 4 minutes, double bottomed right here. And if I drag this to the upside, right, we saw where that consolidation broke. We saw where that pop happened, and it lines up with the second touch, creating that uptrend. Now, this also isn't a magical wall, right? This is just the current ascent of price. We're simply watching this consistent move happen. So that doesn't mean we're going to trust that perfectly, right? Price could definitely break below that, but at least it's giving us some more structure and an idea on where price could bounce if it does reject at this point. So I'm going to hit play very quickly. And before that, you can add EMAs, right? That could be a whole other workshop, whole other video, but EMAs are moving averages, and simply put, they're a trend indicator. So you can see that the 9 and 21, both sensitive moving averages, they're pretty close to price. And if I remove the trend that we just went over, they're going to show you the trend quite well. The only difference is they're adaptive, right? So they move with the price, whereas, or I should say that, right? Static, whereas this stays, of course, as market structure. So I'm going to hit play real quick. We can watch either of those. Let's just leave on, let's leave on both, right? Let's see how they interact with price. I hit go. We start to get a little bit of resistance in there as expected. We start to trace sideways, right? So we're looking, what does the price do at 442? It's that key level we're watching. We're definitely starting to trade sideways a little bit here, right? Not only in here, as I mentioned first, but continuing that move. We're getting close to the EMAs in here if you're using that to identify trend, and we're getting close to that overall trend that we drew previously. So I'm going to remove the volume, right? Just reduce some noise and focus up on what's happening with the price. We hit play. We're looking for some type of reaction in here. All right, looks like we're following that trend still. And it looks like we didn't lose that uptrend, right? So we had that move all the way into almost 443, right? We were just considering fully exiting that position right here under 442. We not only had a move over our target, right? But we had about a point extension above our target. And that is the difference between taking a trade at 80% and then a trade at 120% plus profit. Now remember, if you hit your target and you get out, that's still a great win. But if you have the ability to leave yourself exposed, not with your full position, right? Maybe not even with half, but in something that we like to call runners, or a fourth of the position or a fifth of the position, but some small amount of the position where you're still exposed to that upside. And just think, right? If this uptrend breaks down, or you see a drop in volume, or whatever other indicator or form of analysis you use to determine the strength, if you see a warning sign or if you see weakness and right, you see it or this starts to fall, then you can get out of the rest of that position in profit. And that's still a great trade. But leaving yourself exposed towards that, that's also great, right? Because you could secure more profit. You could have larger average wins. So always consider that, right? You can take your profits at the target, but the same way that we like to see what the trade does at this point, you can still continue to see what the trade wants to do as long as it remains in a probabilistic favor to your side. So hopefully that helped. That's about all I have.